Okay, well, it's a couple minutes after 2, and I think we'll get started. So hello, everyone, and welcome to today's webinar on the landscape for entrepreneurs, startups, and venture capital, brought to you by the IIAC FinTech Committee. My name is Jack Mastromattei, and I'm the vice chair of this committee, as well as the chief operating officer of Aligned Capital Partners. At the start of this year, Scott McKenzie, who chairs the committee, myself, and colleagues from the IIAC surveyed our members, and we asked them for a list of topics that were important to them and what we wanted to cover. High on that list was our members wanted more information into the world of venture capital. So what Scott and I did was we took all the feedback back and we came up with our top 5 list. And the game plan was to host a number of in-person sessions over the course of the year. And at the very end of the year, come together as a very large group at the FinTech conference in Montreal, where we would also present all 5. Well, we all know how that went. And unfortunately, we were not able to get together as a group. However, we did host 5 very informative webinars, and I'm really happy with how they turned out because I think the content was informative and insightful. But what was also great was we were able to reach a very large audience, and for that, we're very grateful. Today's webinar is no exception. We have a lot of people in attendance, and we're really excited about the content, our panel members, and of course, our moderator, Pramod Udiaver. Pramod is no stranger to this topic himself. He too took the entrepreneurial leap and left an executive position at one of Canada's top 5 banks and co-founded his own digital advisory platform called Invisor Financial. That platform has actually just been acquired by Industrial Alliance. So before I pass it over to Pramod, one housekeeping item to mention. You're going to have the ability to ask questions throughout the session by using the Q&A button found at the bottom of your screen. I will be the only one that can see the questions, and I will do my best to intertwine them throughout the discussion. But if I'm not able to get to them during the panel session, I will queue them up for the end and ask them at that point. So without any further ado, I will pass it over to Pramod.
Thanks, Jack, and good afternoon, everyone. Welcome to this webinar. First of all, thanks for joining us this afternoon. It's a very interesting topic on hand, and I'm sure we are going to learn a lot of insights and perspectives from our panelists here who represent the VC world, and one of them being an entrepreneur himself. So, to do full justice to this topic, we have a really good group of panelists, very well accomplished in the industry and their respective fields. So 2 of them are going to be representing the VC world, and one of them an entrepreneur who's now onto a startup, that he co-founded a few years ago, and after a very successful exit. So I'd like to welcome Dr. Dan Rosen, from the CEO of Digit, Laviva Mazhar from Luge Capital, and Michael Sim from Fidelity International Strategic Ventures. So with that, I'll let the members of the panel introduce themselves and tell us a little bit about themselves and their firms. So over to Dr. Dan Rosen.
So thank you, Pramod, and thanks, Jack, for inviting me and for everyone to spend a little bit of time with us. I'm Dan Rosen. I'm the CEO and co-founder of Digit, and Digit is an enterprise wealth management platform. We have great institutional grade analytics and risk management tool, and we really have built a platform that focuses on the relationship between the advisor and their clients. We talk about helping advisors scale up the value and the human services that set them apart in this increasingly automated and digital world. As Pramod said, I've been building risk and portfolio management systems for 25 years. This is my third startup that I've been part of. The second one that I started from scratch, and very, very happy to be here.
Laviva, sorry.
Yeah. Hi, everyone. Thank you so much for joining, and thank you to Jack and Pramod for inviting me on the panel. So I'm Laviva. I'm part of the investment team at Luge Capital. It's a fintech-focused venture capital firm. We invest across Canada and US in early-stage fintech startups. It's an $85 million fund. We're backed by 7 investors that have invested in the fund, including a couple of strategic financial institutions, such as Industrial Alliance, Sun Life Financial, La Capital, which is now merging with SSQ, as well as Desjardins. We work very closely with these FIs, so we hear on one side what's happening on the innovation side in the startup ecosystem, and then also what's happening on the innovation side of these financial institutions, which puts us in a very interesting, unique position. So as I mentioned, I'm on the investment team, and I've been with the fund pretty much from day one, which was a couple of years ago now. And before that, I was part of another firm called First Capital Partners, where we were actually co-creating a couple of fintech startups ourselves. So there I spent a lot of time actually operating alongside some of these early stage fintech startups, seeing some of the challenges that they were going through, and being hands down into those companies.
Thanks, Laviva. Over to you, Michael.
Thanks, Pramod. Michael Sim, and I'm pleased to be being beamed over to you from London. I'm VP within Fidelity International Strategic Ventures team. As the name suggests, we're a corporate venture capital which invests in founders that are redefining wealth and asset management. We typically invest at Series A to C with check sizes of between $3 million and $50 million. We've deployed $70 million to date across 10 portfolio companies over about the last 3 years or so. We invest globally, ex-US, including an early investment here in Canada into a company called Conquest Planning, where we co-invested with Portage. So really pleased to be here.
Great, welcome again. So what we've done is to sort of get through this webinar. We've sort of prepared a few questions around different themes, and I'd like to start off with trying to understand what the current landscape looks like from a VC's perspective, and perhaps Michael, you could get started with this first question, and that is, what are some of the key trends or emerging areas you're seeing in the fintech space in Canada? And perhaps you could also comment on the global perspective as well, given you invest in other parts of the world as well.
Yeah, sure. Maybe if I take the global side first. I think one of the key things we've seen this year is a lot of large rounds, almost mega investment rounds in fintech companies. In September alone, you had 5 companies raise over $500 million each, which I think talks to not just kind of an emerging maturity in the fintech space, but also a lot of dry powder to challenge incumbents even more. I think within that, you're seeing these successful fintechs move from being monoline products where they were kind of unpicking a sliver of a bank and doing that really well, to actually providing kind of more multi-line product offerings. So, the classic example over here is somebody like Revolut, who start with FX, but have moved into stockbroking, crypto, concierge, a whole host of other services. I think the second theme that we're starting to see a lot more of, and we're certainly keeping a strong view on, is around embedded finance. So 90% of kind of SaaS companies have a subscription-based model. And I think you're starting to see fintech infrastructure companies make it possible for those tech providers to add financial services and embed that within their offering to customers, alongside the core software product. And the kind of classic example or forerunning example is something like Uber, where the payment structure is embedded so deeply within the taxi riding service you barely recognize it. It's just entirely seamless. And you're seeing that pop up across point of sale lending in terms of Klarna or Affirm, or even in investing within other app ecosystems. I think the one bit that probably I'm really excited for in 2020 is probably what we're terming the democratization of investments. So if maybe a couple of years ago, the focus was on neobanks, I think 2020 is kind of the year of neo brokerage almost. And there's 3 things that come together to sort of lead to that. So I think for, during the COVID period, for those that were kind of fortunate enough to keep their jobs, spending went down, and so household savings rates went up. at the same time that interest rates went down. So, there was kind of a glut of savings, and people were at home, and they naturally wanted to invest. And there's a new generation of apps that made it both incredibly easy and incredibly cheap to get access to the stock market. You've got Robinhood and Acorns in the US, I think Mocha here in Canada, and then in the UK you've got Freetrade, Revolut, and Moneybox all providing that service. And then the third bit that sort of added to that trend that we've certainly seen is, unlike 2008, the COVID-19 was an incredibly tangible crisis. The focus is everyone can see how our habits changed overnight, how we traveled, ate, where we shopped, exercised. I think that gave people confidence to actually invest into the brands and the winners in that area. So, we've certainly seen it highlighted through the kind of Robinhood investing angle, but I think it's applied more broadly. I think when we look back on 2020, it will have made a lot of new investors. So I think those are a few of the trends that certainly we've seen both in the UK, but probably apply globally.
Laviva or Dan, anything to add?
Yeah, I'd say Michael's assessment of trends are spot on. I'm also very interested in the embedded finance concept. I think I also agree that I think that's going to take off more and more as consumers use various kind of digital platforms. The ability to add on a layer of financial product on top of a checkout process is going to get easier and easier. I spend a lot of time in insurance, particularly, and it's an area, a bunch of our investors in the fund are insurance carriers, and I just find the area very fascinating. And the insurance industry is definitely going through quite a bit of transformation. If you look at Canada, particularly, for example, just a couple of years ago, and we're a little bit behind, I would say, the UK. FinTech came to UK a little bit earlier than Canada. But even a couple of years ago, we didn't really have the ability to actually fully purchase an insurance product online. If you look at the auto insurance or home insurance, for example, and those are now a lot easier to do online than it was a few years ago. But there are other areas as well where they're the traditional kind of brick and mortar brokers and MGAs are managing general agents that are looking to digitize their own tech stacks and make it a lot more efficient. There are AI technologies being used within insurance carriers to make use of unstructured data and kind of pull meaning out of them, make the underwriting process a lot easier or the claim process a lot easier. So yeah, that's an area that I'm very excited about, and I think Canada is definitely seeing a lot of activity in that space.
Very well. Dan?
I fully agree with both, of course, Michael and Laviva, and they have a lot broader experience than I do. But from my side, one of the things that I find truly fascinating is, and maybe building up on Laviva's comments, is this creation of fully integrated finance platforms where you can really now start. It sounds like democratizing finance is a bit of too much of a word, but for example, like I'll just give you as an example. Today we actually announced, so this is like fresh out of the press. We announced our partnership with PCR, with Private Client Resources. It's a phenomenal company in the US that is the best of breed data aggregation platform for financial advisors, for ultra high net worth advisors, and just that ability. So with our platform of creating these platforms, of connecting things and making it available to professionals in an easy turnkey solutions is just enabling, and I think it's going to change completely the way financial services are going to be done in the next 5 years, because it's completely doable. Before, I mean, if you go back 10 years ago, then it was really big financial institutions, big banks who could really support the ability to have a group of advisors or a large group of advisors providing services. In the US, you see a large trend of independent advisors and of advisors going independent. But just I think what I find fascinating, and I think again from the VC perspective and the technology perspective, is that technology does enable that. It's truly one of those things that now it's not that hard for in this case for advisors to do that. But this is happening everywhere, right? Payments. I mean, just the way payments and the connectivity is doing this. And I think that the next one that will come is also smart contracts. This is something that is a new innovation. I was yesterday on, I'm part of the research advisory group of GRI, the Global Risk Institute. And this was one of the areas that I think we all are identifying, because this has just that ability to connect all kinds of products to people, making it a lot easier for those to be available. Just a few additional thoughts.
Great. So recently, I was reading an article that was put out by KPMG, and according to that article, it said the U.S. VCs invested 136.5 billion in 2019, while Canadian VCs did about 4.6 billion. So clearly a big mismatch here, or difference. It seems like what Canada did in a year was done in like 2 weeks in the U.S. So just the question is, why is there such a massive difference? Is it lack of innovation or innovative ideas in Canada, or is it lack of risk appetite, or is it something else? And would love to hear your thoughts, Laviva.
Yeah, this is a great question. And I don't know if you read this, Pramod, but BDC's fund management team has been publishing a bunch of studies that they've recently conducted on, how Canadian VC performance is going compared to US VCs or global VCs. I'd say that, to be honest with you, at least from my anecdotal experience, I think that there's more money in the ecosystem right now to be invested than ever before. If you look at, Luge, we raised our fund in 2018, so not too long ago. There's multiple other funds that have launched with, $100 million asset under management, or, pretty sizable investment funds. You have to compare the scale of Canada to the US. So US, we often say, is 10x the size of Canada, right? If you just look at the population. There's also, if I just look at FinTech, we're probably tracking about 800 to 900 FinTech startups in Canada, whereas US, you're probably looking at more around 4,000. So just the volume of startups in the US is a lot higher as well. There's a lot more funds in the US compared to Canada, and the exit potential in the US has been seen to be a lot higher as well. There's just a lot more exits that have happened, a lot of entrepreneurs that made money through those exits, and they're reinvesting that capital into the startup ecosystem as well. So I think that Canada as as the startup ecosystem, we are on a path of growth. But I think compared to the US, if you just look at the numbers, it's actually not that bad, because you have to compare, the size of those two markets.
Michael?
Yeah, look, I think it's something that a lot of countries and cities have grappled with. They look to Silicon Valley and say, how do we replicate that ecosystem? And it is an ecosystem sort of play that becomes more and more self-fulfilling. I'd say even that London in some ways sort of struggles to replicate that high concentration of kind of world-leading tech talent. That gets kind of, you have this honeypot effect where the best talent wants to go to where the biggest tech companies are. They then get developed and nurtured, and then inevitably spin out and start their own innovations. So you kind of, you need to, it's very hard to just say, well, we'll put in place some regulation that will replicate or mandate that. I think London, probably from a fintech perspective, has always been, used quite well its position as a leading financial center to try and create that same ecosystem around it. But these feedback loops, it's very difficult to sort of say, how do we create a mini Silicon Valley in X? But I think there's definitely ways that you can encourage that and cultivate that. and it's often starting from kind of first principles. So, Canada has some great universities, world-leading universities, especially in things like computer science. Making sure that the grads that spin out of there, you have a rich angel and seed ecosystem, and that early stage piece I think is vital. And then shout about your companies as well, so it'll attract inward investment. I think certainly when we invested in Canada, we invested at a stage that was probably a bit earlier than what we normally do, and I think that's quite interesting. We normally come in slightly later, but actually we saw a team that we thought were immensely backable and decided to go earlier than we would naturally. So I don't know, maybe that's part of the puzzle, is just that flywheel effect, and making sure you have enough early stage and high net worths of seeding those companies before the likes of those Luge come in.
Sure, Dan, anything to add?
Well, I just want to highlight, I think, a little bit of one point that Laviva made and Michael stressed, which is I do think that from a VC perspective, like the capital itself, the US, and as Michael mentioned, particularly the Silicon Valley culture and some of the East Coast, is very, very hard to replicate. But when you think of innovation itself, I mean, as Laviva mentioned, there's 800-900 fintech companies here, 4,000 in the US. It's less than 10x. So actually, like the difference, and I think the innovation piece is something we've improved a lot in Canada, particularly early stage companies. I do think that one of the areas where we are as a country and as a culture falling behind is the scaling of that second step of scaling. We are not as good as our neighbors in the South. Both the culture, I think the expertise in sales and marketing that is required to really scale companies. That's one area that I do think we today are behind the US, but not early stage. I think in early stage, Canada is now phenomenally innovative. As Michael mentioned, our universities, Toronto is the center for artificial intelligence, machine learning, one of the centers. So is Montreal, and even Alberta is a phenomenal place. We have some of the top companies in the world setting up some of the research centers or hiring people from here. So it's something we will continue to grow. I'm very optimistic about it, but I do think that as a country we have to focus on that second stage. I think it's that scale up piece that today is not up to par, I think.
I think Pramod
we seem to have lost. Yeah, I think we seem to have lost Pramod.
Sorry, guys. Yeah, we seem to have lost Pramod. So let me jump in here. I've got okay. I can keep things going here until he comes back. The next question, just on this theme, was something that I think is very relevant that we should just touch on: is what impact, if any, has COVID-19 had on the current VC landscape?
I can speak from my experience.
Yeah.
So I'd say that the first 2 months since the pandemic was declared, so at least in Canada, which was in March, from my experience, both for our fund and most of the other VCs I've spoken with, the first 2 months, they were really looking inwards, trying to focus on making sure that their portfolio companies are well taken care of. So, doing cash flow planning or budget adjustments, if there are any internal rounds that need to be raised so that they can extend their runway, or even just reassessing how long they should raise their round for. So those were some of the things we focused on. And then after that, it was really business as usual. I'd say that probably in a way, I've even had the opportunity to meet more founders because now you're doing everything on Zoom rather than in person. So scaling your process, I guess, as a VC. I've personally seen, and also the feedback I got from some of my other VC colleagues, is that rounds are actually getting, like, how do I say this? Like, deal activity is actually increasing in a way, and they're also getting very competitive because a lot of VCs have decided to focus, rather than, you know, backing maybe a very out of whack idea that may or may not have a very high chance of success. A lot of VCs have decided to focus more on startups with a stable kind of maybe revenue generation, some demonstrated traction, and very easily accessible kind of market fit. And as a result, a lot of attention has started going to those specific startups, and deals are getting a lot more competitive. Like, if you're slow, then you might even miss out on a deal. I've spoken to some startups that have gotten, like, received 5 term sheets, for example, and so on. So I would say that actually the dynamic is really interesting. And the last comment I'll make is that I was expecting that because of COVID, maybe there would be a reset of valuation bubbles. And I feel like it's actually gotten worse in some ways, or at least there has not been any reset whatsoever.
Interesting. Michael, something to add?
The reset in valuations happened for about a week in March, I'd say.
Yeah, exactly.
Yeah.
So yeah, look, I'd echo entirely what Laviva mentioned in terms of process. We focused on the portfolio for the first few weeks, you know, making sure they were well supported, making sure that, you know, their teams were well supported, and that, you know, frankly, going into this, no one quite knew what would happen to anyone's revenues. So you stress test models like you'd never stress test them before. You kind of cut revenue entirely and say, how long can you last? Fortunately, I think the way that it's played out, certainly for the portfolio companies, has been significantly better than that. I think in terms of kind of D2C type companies, you know, as I sort of alluded to in the opening remarks, you know, anything that's mobile centric, you've actually, in spite of us all being sat in our homes, mobile usage has increased 20% year on year.
Interesting.
So, you know, if you've got a proposition where you can market direct to consumer and they can download or engage with it in that way, it's actually, it's been an accelerant. I think for B2B fintechs and entrepreneurs, it's maybe been a little more mixed. I think kind of corporates' priorities have clearly changed, and, you know, they've recognized that they need to digitize their workflows and remove any manual tasks and interactions that kind of worked okay when you're in an office environment, but remote really do need challenged. So actually, a lot of B2B fintechs, I think, are seeing their pipeline open up and do really and look really promising. We have seen, certainly across our portfolio companies and other companies that I speak to, you know, maybe a slowdown in kind of that enterprise sales process. So while you can get lots of meetings and you can build up enthusiasm, I think sometimes within an enterprise B2B space, it has slowed down during COVID somewhat. Maybe just on the funding piece, I think good companies have continued to get funded. It's certainly, you know, continued to be competitive. I would say the investments we've made are probably into companies where we had a relationship pre-COVID. We had that kind of face-to-face relationship, at least initiated pre-COVID. I wonder if you are doing very early stage investments, how easy it is to build conviction when there's less data or revenue to kind of confirm through your diligence process, and you're really just backing an entrepreneur and an idea. But I think, yeah, we certainly haven't seen early stage investments completely dry up. And if you look at it on a sort of global basis, again, you know, fintech financing volumes are not far off where they were this time, you know, in 2019. So, you know, I think everyone was nervous, as was true across every sector, you know, around March, April time, and then very quickly we got with the new normal.
Interesting. And Dan, has it impacted your trajectory and how you're navigating in this space?
Look, I can't comment on the overall VC market. I've been with my head down trying to manage a business through the pandemic. And look, we've been massively fortunate. We're some of the fortunate ones. We've had a great year. We're going to almost double revenue in a pandemic year. So I just feel tremendously fortunate for all the conditions. We made very conscious decisions to really stay focused on our clients and figuring out how to engage with them, and also how to engage within our whole team throughout these remote things. I mean, I think we've gone through all the stages where the first couple of months, I mean, we were already half remote anyway. Our development team was working at least 3 days a week from home and all of that stuff. But of course, everyone that I talked to went through the same cycle. The first couple of months, massive increase in productivity. Everyone almost excited. Just our ability to close development tickets and to do stuff and even close deals, like our productivity really went up. And then it started to go normal again, and now we are hearing from our team a little bit of fatigue of being fully remote. I'm completely of the opinion. I have some of my CEO and founder colleagues that have made decisions on going and being remote first companies. And I've always said that I did not want our company to be remote first. I truly believe in people meeting and collaborating, and that's how you create innovation. Innovation is not created by individuals. I think that's a myth. It's sometimes looks like a great thing, but it's really of how teams build and collaborate and are able to do things. We luckily have things like Zoom, so we can not completely kill collaboration in these times, but just that ability to do that in person. We did have periods over the summer, a little bit in the fall, where we got small groups coming back to the office and collaborating, and just things that we were building in the product just got a little bit better. So I'm very optimistic about it. And look, this is going to happen. It's just we need to be patient for another 6 to 9 months, I think.
Good stuff. Hey, welcome back, Pramod. I know you dropped off
sorry
for
about
just a short
that.
period. No problem. I just finished a question on COVID, so if you want to pick it back up, please
Sure,
do.
yeah, thank you. Thanks for doing that. So really, wanted to sort of switch gears into our next theme, which is to sort of get a better perspective on a startup life cycle. So maybe I have my next question, which is sort of a two-part question. And the first part, I would like to address that to Dan and get a little bit on the personal side. So Dan, why did you start Digit, and how did you size up the opportunity? And it'd be nice to hear that personal side from you. And the second part, I'll ask Laviva and Michael after. So Dan.
So I'll start by saying that my conditions and all of these things are very idiosyncratic, I think. But I think that's true for almost every founder that I talk about. I do believe that timing and a set of circumstances outside of our control always play a big role, and so it's a little bit of luck. So I started Digit. We started Digit around 2016, and my two partners and I have been working together for 20 years. This is the third time around, but the last company, R-Square Financial Technologies, we sold to S&P. And we stayed there for a few years doing some of the integration. I ran the risk analytics group. And I'd love to tell you that we started Digit because I had this great idea. Let's build this wealth management platform. No one has it. Wealth management is such a new thing, right? Like no one has ever thought of building wealth management platforms. But it didn't happen at all. Like on our R-Square side, our clients were hedge funds and large institutional investors. And it was the idea of a couple of our hedge funds, like completely. It was not our idea at all. We have a couple of our hedge fund clients that were telling us, this thing that you built for us, I think you should go and look at that space over there. because those guys, their technology is always behind the institutional technology. They don't have very good analytics. They don't have very good client engagement tools. They can only produce quarterly reports on their data, if at all, and they can't look at stuff. And so with that in mind, that's how we started. We said, okay, maybe we should, when we left, we said, let's go and look at that space. And we started going and engaging clients. One of the things we've done is, I always believe on going and to the market right away, going and talking to people right there. I don't, and asking. So we went and asked, I figured out who did I know that was a wealth manager or had providing services. And we went to ask everyone, and we were saying, we have this idea. We have people telling us this is useful. Would it be useful? And we found a tremendous response. Like right away, we got one of our first clients, investors, saying, oh, this thing, if you build it, I've been looking for it for a year and a half, and I'm about to sign with someone, but it's not really what that thing that you're talking about, that's what I need, and I can't find it. So then we realized there was a need. And then we realized there were people. So we managed to get 4 early adopter clients to work with us for about 12 to 18 months before we even had a full product. And so at that point, we said, okay, we need to do something about this. If people are willing to work with us before we have a full product to do. So we were very fortunate, and we jumped at it. I think that's the key thing. I think that's the entrepreneurial merit, that where I do give myself a little bit of credit with my team. We jumped at it, and we jumped at it not halfway. We really went at it. We said, this is important. How do we do it? We got investors very quickly, and have been managing to really grow. So I think timing, to me, the key thing from an entrepreneurial side is timing and being able, and luck, but being able to recognize it. I think that what good entrepreneurs do, or really good ones, and I don't consider myself all the way there, but just they can recognize that, and they can jump at it, and they know who to go and ask and get those resources to make it happen. So from my side, that's a little bit of how we did it. This is how we decided. This is how we went at it. And we really looked for investors that not only would give us money. I mean, we were in a good situation for many reasons. Sometimes as an entrepreneur, you don't have a choice. You need to just take any money. But if you can, I think, look for partners. To me, everyone, you're going to spend a lot of time with some people in your board. They're going to be your partners. They're giving you their money. Of course, they want you to be successful, and they want something in exchange. But so you might as well work with people you like, that you think are going to help you, and they're going to give you good advice, and that they're going to have skills that you don't have. That was the other part for me that was important. I wanted to have some partners that were financial institutions, that were working on the other side. I've been building systems for financial institutions, but I've never worked for one, like, directly. So I think that's key. Look for that. Those VCs or investors, could be angel investors, could be that you think are going to also give you more than money, who are going to help you, who are going to guide you throughout this thing. And to me, that's absolute key.
Great. No, thanks.
I can go on for a long time, so I'm going to stop.
I understand. I can see the passion. Yeah. So thanks for sharing that, Dan. So my second part of the question is to maybe Laviva, you can go first, and then Michael can follow. So you probably have lots of Dans and Pramods pitching to you on a regular basis every day. So how do you, as a VC, assess this opportunity? What are some of the key characteristics and perhaps even red flags that you would look for in a pitch? Especially specifically keeping in mind the stage at which the company is.
Yeah, I definitely don't always have Dans and Pramods pitching to me. It definitely, there's definitely entrepreneurs that stand out versus entrepreneurs that don't. And I think that's definitely every VC will tell you, especially at the early stages when you don't have a lot of numbers and validation and customers and whatnot, is a very strong team. Either they have the industry specific background or just understands the space very well, or the connections in the industry so that they can go and actually sell their product, or they're very technically adept. Like something has to stand out about that entrepreneur and their team, and who they're able to attract to their team is key. I'd say one point that is sometimes difficult to communicate with founders, because remember, like 99% of the times we're saying no, right? So one of the big things is a large market opportunity, because if you look at a VC's model, let's say if we're a fund that's going to invest in 30 companies, hands down, majority of them are not going to return your fund. They're not going to be unicorns or billion-dollar businesses. Some of them will return the initial capital, some will fail, some will give you 2, 3 times or 4 times your return, but really that 10x or 20x return, that maybe 1 or max 2 companies. So that means every time you're assessing a company, you have to believe that this company can become that massive organization in 7 to 10 years or whatever. So that means the market opportunity that they're going after has to be big enough so that the company can become that big within that space, right? So large market opportunity would be the second one. And for me, I mean, I do like to see a little bit of early traction. So as Dan was saying, for example, he found 4 early adopters that he was really working with to build the product. And that is a really good angle, right? Because your customers, when they're helping you build your product, you're getting feedback exactly from where the money would come eventually. So it's, they're going to tell you exactly what their problems are. And of course, you have to decide which of that feedback you're going to incorporate, which are, maybe not worth incorporating with limited resources. But I think early demonstrated traction is another point that always works, at least for us at Luge. Maybe a few red flags before ending my comments is, I think founder VC fit is super important, because sometimes, most of the times you're working with them for a pretty long time. We also say that sometimes it's longer than how long marriages last. Sometimes it's messier to get out of it than marriages, maybe. So really that VC and founder fit is super important, whether the entrepreneur is coachable, whether they're transparent, they're honest, is super important. Anybody who hides information or tries to window dress information or traction is a big red flag for me. And the last one I would say is maybe like weird ownership structures. Sometimes an entrepreneur will go and they'll have like 10 co-founders, each with 10%. Maybe some of them are not committed and they're going to leave the business in a year or so, right? With a big chunk of the company. Or there's a weird, inactive co-founder that has like 50% of the business. So all those things are a bit weird for a VC to deal with, knowing that we're putting in the money so that, the entrepreneur stays motivated and has enough ownership in the company.
Michael?
I'm not quite sure what I can add to what Laviva's very articulately described. Look, I think maybe just reinforcing a bit of both of the last answers. As a VC, you have kind of one shot at making that investment. You can't turn it down and then decide a week later that now's the time to invest. So everything is geared towards building conviction that this is the right allocation for your capital. And as both previous speakers mentioned, this is a partnership that you're going to be getting into for hopefully multiple years, and so that conviction piece around the team, and not just do they have those sort of unique insights and capabilities, but is there that sort of team market fit? I know we mentioned the sort of fit between VC and founder, but actually the founder and their market, do they truly understand it? And can you build conviction? Have they either built something and sold it in the past that's analogous to what they're doing now, or do they have something in their DNA that means not only have they got a great idea, but you can get confidence that they're going to be able to execute on that? On product and market, again, we do thorough diligence on each. The market needs to be big enough to be able to get conviction that you can get that 10x if it does do well. And then the product, depending on how mature that company is, you'll have more or less in that space. So, later on, the product becomes more and more vital because that's what customers are using today, and any hiccups in it, you'll see churn, etc. So, the later stage that you're investing, I'd say out of the three pieces of team, product, and market, that product piece becomes incrementally more important. I think the only other red flag that I'd add to what was previously mentioned is, we often see someone come in and say, look, if we only get 0.1% of this huge market, we'll all be billionaires. And that's nice, but it kind of ignores the importance of go-to-market strategy and actually a bottom-up kind of approach to the market and saying, look, these are going to be how we, these are our early customers. This is how we're going to get them to adopt our product, and this is how we then expand. And adding some realism into it. It's great having a huge market, but it's not a big blue ocean. Typically, you need to have a really solid execution strategy.
Great. My next question, really want to again switch gears and ask a question that really represents most of the members watching this webinar, I suppose. So as you know, several of these members are perhaps as part of their firm strategy considering either partnering or acquiring or building their own technology. So my question is really sort of two-part. The first part is sort of with regard to the ownership. Does it make sense for companies to to take ownership stake in a startup, or should they allow those companies to mature on their own and simply become customers at the beginning? And the second part is around the build, buy, partner sort of decision. So for companies that are concerned about making large investments in technology that's changing so rapidly, what is the best strategy? Buy, build, or is there a hybrid approach? And perhaps Laviva, you could start on this.
Yeah, I think Michael would be more suited to comment about the ownership piece from an FI, but I can say that I think FIs investing in startups is becoming more and more common. Typically, I see them coming in a bit more at that Series A and above stages, just because at that point, maybe the company is already working with that FI, and there's a strong conviction that the financial institution has that this is something that can really grow. And the corporate VCs, like they're not like they're very cognizant of the fact that that company will be working with other financial institutions as well, right? So you cannot invest in a company and just expect that they will be only serving you. Like the way that they grow and return the capital of that CVC is by working with other FIs and really growing their sales. I think that if you are a startup that's raising capital from strategics, it may make sense to diversify that a little bit just from a market signaling perspective. So if you're raising from one bank, let's say, it might make sense to also try to bring in another bank as so that the market doesn't think that you are providing some sort of a competitive advantage to that investor. So that kind of, or having some sort of a governance in place to make sure that there's a, kind of Chinese wall, so that as an investor, yes, you're getting information, but you're not necessarily having competitive advantage over others, because again, that might prevent you from being able to sell to other FIs. So that was that piece. And what was your second question? Sorry, I kind of.
Well, it's about the build, the buy versus the build.
Yeah.
A decision.
Yeah, that one is a bit hard for me to comment, but I can tell you that our startups that sell to enterprises, it's often because they're bringing some sort of an expertise that is missing from that FI. Financial institutions have so many different priorities right now. Even just the fact that a lot of their technology stacks are still kind of the monolithic, old school architectures where you can't really scale that without, massive undertakings. And so sometimes it's difficult for them to do quick tests of some technology that they came up with, right? And so if you already find a vendor that's out there and they've developed that and that is their bread and butter, it might make more sense to work with those startups or tech vendors rather than trying to build everything on your own. It's also, and I'll say this, which is often difficult for startups to work with, is sometimes FIs will ask for exclusivity, right? And then as a tech provider, like you cannot necessarily give exclusivity to somebody for an indefinite period of time and so on. So that becomes really hard for early stage startups to navigate, because you're kind of at their mercy to get that contract so that you can show your revenue traction and you can go close other clients. But then, this particular FI will come and say, you have to give me exclusivity, and that becomes a very difficult decision for startups.
Michael?
Maybe I'm going to be slightly controversial in this one, but I think most corporates shouldn't invest in startups. I don't think it's their primary function. I don't think that they've typically got the risk, the foundations in place to have that risk-reward appetite and to experience, as Laviva said, a portfolio of 30 companies where you expect a proportion of them not to make it and a couple to 10 or 20x. I mean, that's a volatile journey, and it's not their primary function. They're set up to serve their end customers, and often investing in startups is not a direct way of doing that. I'd say it comes back to an alignment point, and I think it's vital for both the entrepreneur, other VCs, and that strategic to take a true view of why is the corporate investing, and is there true alignment between the corporate's goals, the entrepreneur's goals, and the other VC's goals. I think we're quite fortunate in building the foundations of our strategic ventures team. We've all come from a venture DNA, and so we were quite militant about we want to be able to say that we're going to exit a whole big plan. We're not building a funnel for acquisition here. We're intending to make money, and that drives alignment between us and the entrepreneur. But we think, given our proximity to Fidelity, we can take we can add more value on both sides of the equation, and hopefully have a better chance of success because of the diligence process that we can go through our proximity. But I'd say we're the exception rather than the rule. A lot of corporates may do one or two dipping into investments, and that might be great if you've got one person who's evangelizing this. But if that guy leaves, because he doesn't have the same tie-ins as the VCs do, then you can end up with these orphan investments. It ends up being more of a headache than how charming it looks when you're going in. I guess we're quite focused on the fact that we don't invest in every company that we think is great or is even a vendor to Fidelity. I've sourced and seen companies that I think I'd love to have invested in. It doesn't fit within our remit, and I've introduced them to, for instance, a payments company in the UK to Fidelity. Since I introduced them, they've done 2 rounds. They're doing great, but it wouldn't have been, we wouldn't have added any value really to taking to making a VC investment on that, even though they're a great company. So I think you've got to be honest about your motivations and how they're all lined up there. In terms of buy, build, when it comes to technology, again, it kind of depends on how core what you're doing is to your operations and whether you think you're the best place to do it. Every tech team in a corporate can say they can build it given enough time and money internally, and it'll be the best. But the truth is, how long I often find that fintechs with a dedicated team that will consistently upgrade what they've built and keep it at the cutting edge are far better. So I think that hybrid approach of working with a fintech is often the best, with the proviso that you don't bespoke it so much that it becomes a de facto build. I think that's the caveat there in terms of that hybrid approach.
Great. Dan?
Well, I'm going to maybe get even more controversial. I would push it a little bit further. I fully agree with Michael. I think financial institutions should focus on what they do best, providing financial products and financial services to their clients. They're not VC investors. I agree with that. And there has to be a very specific thesis for them to do that. That's very unique. And maybe there is some, but they're also not tech companies. I've seen this for 25 years. Every bank in the 1990s tried to build their own risk management system. Everyone. And they thought they were better at doing that. They spent millions of dollars. There comes a company like Algorithmics or SunGard whose services and products are still alive. Like they're still being used over 25 and 30 years, while all of those banks, all of them, not a single one, ended up getting a product or a set of product from vendors. All of them. There's not a single one that didn't. And maybe there's one or two who have some competitive advantage, but they're so non-unique. So yes, there might be a very early part of the cycle where it pays off, and maybe it's so unique, some of the products and services, that it's not worth for any fintech company or any technology company to really go and do it, because you do have to go and see that there's a full market. But as soon as there is a market for that and other people are going to use it, there's no way for any of these financial institutions to compete with guys like me. They can't. I can move at warp speed. I can build teams, make decisions without anyone having to do, and build product with other of their competitors much faster. And I say me, but there's people that are much better than me. So I just think that financial institutions need to learn how to work with these companies, figure out as clients what to request, and so that they can retain some of their uniqueness, some of their key things, and figure how to partner better as soon as they can. And I'm very biased. I fully acknowledge it, but I've just seen it in too many areas in there. Even many hedge funds that originally, I can see it why they want to retain some of their their key formulas and maybe their key things, but all of them ended up getting all their back office outsourced. All of them ended up getting their trading systems outsourced. Very few of them use their own nanosecond trading platforms, because there are such good commercial platforms that do this at scale. So as a short-term solution, it's probably okay to think I should build, but they should be thinking very quickly, how can I partner with someone for them either to take over or do this? And how can we stay focused on doing what we do uniquely in there? Anyway, I as I said, I'm sure I'm very biased in this.
No, thank you. I know we are coming up to time. So Jack, are there any questions?
Yes, there are some for sure that have come in, but we've unfortunately run out of time. We're hitting up right against 1 o'clock. So I think what we'll do is we'll take them offline, and I'll get them to the various panel members, and we'll get back to you with some of those answers. And I know there was other content we wanted to cover. So if there's enough, maybe, who knows, maybe we schedule another one of these in the future. But again, guys, I think this was a great session. I want to thank all of you for taking your time, our panel members, of course, you, Pramod, for taking your valuable time and sharing this info with us. And thanks to everybody who joined today. And you all have busy schedules, and we thank you for joining us. Certainly a big thank you to the IIAC for continuously providing us a forum to host these events. And I guess I'll just sign off by saying the year's coming to a close. I think everybody would agree this has been a year like no other. But good things are around the corner for sure. I wish everybody a very healthy and prosperous 2021. So thank you very much.
Thank you.
Thank
Thank
you.
you.
Thanks, guys. Thanks for having me.
Thank you.